So hello and welcome to the Books Crypto Club catch-up on Zoom. This is a weekly catch-up that we have for members of the group where we talk about cryptocurrency news, Bitcoin, Ethereum, whatever else is happening really. We share information, knowledge, experiences, ask questions. So hopefully there'll be something in this that will be of interest to you. If you do enjoy it, then don't forget to click on the subscribe button, click the like and do anything else that YouTubers do. And I hope that you'll find this of some interest. Jonathan, good evening.
Hi Gary, how are you?
Not so bad, thanks. How's life?
Hey?
Living the dream.
Yeah, it does get a bit the same, doesn't it?
Yeah. As I say to people now, because people say, what are you doing this weekend? I said, I don't have weekends. I operate a 3-day week. And they go, oh, how does that work? And say, well, I have yesterday, today, and tomorrow. And that's a 3-day week. The whole notion of weekends and working time have completely gone.
I know, everything just blurs into one, doesn't it?
Exactly. So you've been keeping pace with what's happening in the crypto world this week?
Yeah, I must admit it has become a bit of a hobby. In fact, not even a hobby, more of an obsession, I think.
Yep.
It's over the last 3 years, it has been really quite an interesting journey, and to follow everything, you know, the huge ups towards the end of 2017, and then the 3 years of depression, and then things, you know, starting to pick up again, and just watching developments around the world. It's quite fascinating, actually.
I find that the more I'm in it, the more I see cycles happening. So as you say, in 2017, you had the whole crypto bubble, crypto hype, which was very much price driven, around, you know, hitting $20,000 and that kind of thing. But then you had the continuation with the ICO hype, with everyone getting really excited and loads of pump and dumps and things going wrong with that. Then you had, for a while, smart contracts seemed to be getting really exciting for people, and tokenization and that kind of thing grew. And tokenization seems to be really gathering pace at one stage. And the whole idea of fractional ownership of assets and that kind of thing, that seems to have waned away a little bit. And the current buzz thing now is DeFi, with the whole decentralized finance and Lego blocks of capabilities all plugging together. And that, again, is exploding. And I'm already seeing that the failures as a result of that, with things not being tested properly, people not realizing what the systematic issues are of plugging things in together, which is kind of a repeat of what I've seen twice before now.
Yeah, and it is so reminiscent of, you know, the sort of early 90s, the uptake of the internet, and so many different ideas and different avenues that people were going down with all sorts of, you know, great new business ideas and whatever. And it is just so similar in many ways. But the difference is this time you've got the internet to actually use to follow it and research it, which, you know, 20 odd years ago, obviously there wasn't. But,
well, this is the thing. If you look at how much information there is that's accessible now, it's grown beyond merely exponential. You know, it's very easy to get hold of information about many things. And the problem I find now is trying to keep pace with everything, because there is so much going on.
Yeah, you got to pick your sources, haven't you, and just focus on those. And gradually you start to have a checklist of the ones that you enjoy following or trust that you read when you're reading it. And occasionally you come across another one and you might add that to the list, and then one of the older ones gets a bit boring and a bit monotonous or whatever, or something happens with it and you sort of ditch that one. But yeah, there are just too many sources of information.
Well, that's where I'm trying to work out now, and I'm trying to run this through at least one of my websites. It is a way of working out how to aggregate aggregators. And so, like on Twitter, I use a Twitter list, as that's a great way of aggregating Twitter content around a particular theme. And I can feed that through to a Twitter feed which I do for my own stuff on one of my websites already. The same with LinkedIn. You can get LinkedIn story feeds and that kind of thing now to come in. And it's beginning to be the same with Instagram and various other things. What I really need is a single platform that pulls in all of the feeds and presents all of them at the same time, and ideally does it free. Because there are a couple that do it, but they are chargeable at the moment. But I might end up paying simply for the convenience and see where we go. So at the moment, I'm trying to work out how to link in Facebook feeds, Twitter feeds, and LinkedIn feeds all into the same thing. So I just have the one place to go to. And there's a couple of websites as well. I think I shared one with the forum the other day, which is an aggregation of all the website feeds. So that's fantastic. Hey, Mark, you joined us as well.
Hi, Mark.
Evening. How are you all doing?
Hey, not too
Good.
bad.
You well?
Yeah. We're just talking about the plethora of information sources these days of how there's just too much out there.
And and it's also trying to work out which one is a reputable source, which can be quite tricky.
Yeah.
In its own rights.
Yeah, and I guess part of the problem, part of an issue, is that you tend to seek out those sources that sort of confirm what you already believe.
Yeah. I think that's why
You're more convinced that you're absolutely right and the coins that you're invested in are absolutely going to go to the moon, and then you're horrified when they don't.
yeah.
It's like searching when will Ethereum go to like 30,000? Like you keep searching, it's like there is one source at least that will say it.
Yeah, there's one guy that's predicted it will go to 30,000. He must be right.
I suppose that's the thing, that I'm looking at all of this from a blockchain perspective and not from a crypto perspective. So I think you're absolutely right. I'm a member of all sorts of forums and groups, whether it's WhatsApp or Facebook or whatever, and they are all self-reinforcing type things. That if you go onto there's one for Link, and Link is just made up of absolute advocates who just love it, and you can't say anything bad about Link, and it's going to go to the moon and everything like that. But it's an echo chamber, so you don't learn anything from it. Hey, Vinod, good evening.
Hi there, everyone.
So has anyone got any other favourite sources of information or places that they like to go to?
There's one that I've seen online, and I know Ivan on Tech uses it, where he looks at the social media kind of coverage of different crypto, and I can't remember what the site is called.
Yeah, there was one. I went to a talk a couple of years ago by a couple of Russian guys, I think it was, or Ukrainian, and they developed a piece of software that actually looked at all social media feeds and everything to work out, what was getting attention and that kind of thing. But I think that there were some fundamental flaws with their methodology, and so they were saying things like, you can see that a price is going to go up if it gets more users on the network. And unfortunately, they were quoting, there's a law, the name of which escapes me at the moment, which is about the power of a network. And basically, if you increase the size of a network, each additional node adds value to the network. But that doesn't work with Bitcoin, because they were counting each wallet as a node. And a wallet isn't a node, so it's kind of fundamental. But they had the right idea of taking social media sentiment analysis and that kind of thing. So that was quite good.
Yeah, there are a couple of sites, and I've seen them recently. I just can't remember the names of them, but if I remember them, I'll pop them into the chat.
Yeah. But certainly, the one I'm using more and more now, I think, is Crypto Compare, simply because that's an aggregation of news sites or of websites and that kind of thing. So that saves me going to Cointelegraph and all various other ones, Coinbase and that, because it just automatically aggregates all the news. So it means it's being updated probably about every 15 minutes or something. So that is quite a useful one. And the likes of CoinMarket.cap and CoinGecko for prices, irrespective of whether they're accurate, they show the sentiment and the direction, which is quite useful.
It's Metcalfe's law.
Metcalfe, yep.
Yeah.
Yeah.
Yeah, on different pricing, because each exchange has a different price. Uh, um, would you see like systems like what Swissborg folk are doing to try and get you the best price, being like good hot topics or hot projects in the next few years as to kind of what's going to launch and what's going to rocket if one's looking for price increase?
It could be. I mean, I know that a couple of the people at Swissborg, they're a really good bunch. That they actually know what they're doing, and they're really good in the social community type thing as well. So they'd actually speak to you, and you could chat, and you get to know them. So that they've certainly got the right idea. As to whether the end game is going to make much of a difference, I'm really not so sure. I still think most crypto is random. And you can use what you want to predict as to whether something's going to do well or not. Sometimes it works, sometimes it doesn't.
Yeah. There is a question that I've got. When all the 21 million Bitcoins are kind of mined and all out there, right? When it's what, 2040?
2140.
Yeah, sorry, 2140, yeah. What's going to happen to the price, predicted? Is it going to just like flatten out and it's going to stay the same, or will it fall off a cliff?
It's going to do one of three things, definitely. And I don't usually offer financial projections here, but it's definitely going to do one of three things. It's either going to go up, down, or stay the same.
Sure, of course.
But the reality is, I mean, I don't think we'll ever get to the point of still using Bitcoin in its current form in 110 years' time or 120 years' time. Because when you work out when 2140 is, that's not enough time on the clock. It's not in a few hours. It's over 100 years away. And the technology will have moved on since then. I was on another forum today, and we were talking about technology evolution and how much energy Bitcoin consumes. And I was saying, yeah, but Bitcoin's in its early days at the moment. And if you look at other technology evolution, and I always use the motor vehicle as an example. So anyone care to offer when was the first motor vehicle? What year?
1905.
1905, good answer, but wrong.
1890
or something.
I heard 1890. What was the other one?
Yeah, I said 1890 as well.
Yeah, okay. So it was 1769, and it was a steam-powered tricycle for the French army, and it operated at just over 2 miles per hour, carried 4 people, and had a range of about 15 minutes. So incredibly inefficient, incredibly didn't work and whatever. But it took over 200 years before we got to where we are now, where we're now using electric vehicles instead of petrol, diesel, or combustion engines even. Now, that was the speed of technology acceleration in the motor sector. You look at airplanes, first airplane 1903 with the Wright brothers, single propeller on it, blah, blah, blah. You now look at jet engines, that took about 100 years to get there. So the evolution's halved. With crypto, Bitcoin's only been around for 10 years. So give it another 10 years and it'd be radically different. So I think we've got a lot to develop here.
So kind of like the use cases will be different, or certainly the way people have found value in it will be different.
I think both, and the way in which it operates as well. So at the moment, the last Bitcoin will be mined in 2140, because that's the way proof of work works and everything like that. It's entirely likely that well before then, they'll adopt something like proof of stake or proof of elapsed time or some other methodology that will completely change the way mining's done, or the way coin correction is done. So we'll see. But as to which way it is, no idea at this stage. We've got a long way to go, yeah. My thinking is it's more that it's going to be things like the adoption of the technology that is going to accelerate price increases. So I say to people about regulation. There's increasing regulation coming into the crypto space at the moment, and that's actually good, because what it does is if crypto becomes regulated in some way, as long as it's reasonable regulation and not overbearing, then that allows hedge funds, asset managers, pension funds, all this to start moving in. So the kind of stuff that Tesla has done already and MicroStrategy has done already. But, you know, the assets under management of a hedge fund are, you know, some of them must be in excess of $1 trillion.
Yeah. So I work for Legal & General, and Legal & General have $1 trillion assets under management, and Legal & General are quite small in the grand scheme of things.
Yeah.
So it's multi-trillions. People like, is it BlackRock?
BlackRock's one of the big ones.
Yeah, absolutely massive.
Yeah. So you look at
bigger than a lot of countries.
So it's quite interesting though, like because in India they're trying to ban the was it private crypto? So you've got to have use the national one, but then so they're going to develop their own one. But then you've got Miami, who are wanting to transact in Bitcoin and crypto. So you got two totally different ends of the scale, and now we've got New York who are saying, look, we also want to be the crypto city.
Yeah, in India's going around in circles at the moment. I'm fairly au fait with some of the activities. I did some work in Calcutta, and I ended up being asked to help the Bengal government do some stuff. So I take an interest in India, and what seemed to be actually happening for a while was RBI, which is the overall regulator, was becoming fairly sort of supportive of crypto for a while, then cooled off and went against it. Then the Supreme Court made a judgment about crypto to confirm that it was actually legal and it was okay to use. But now RBI has come out with another thing to say that they're going to go to the government to propose a bill which may outlaw any private crypto operation. So it would be, if it was state operated, it would be okay, but private would not.
What do they mean by private in that instance?
Not owned by the government.
Right. Okay.
Or
so
not approved. Would that also include not approved by the government? So an organisation, private organisation, but with official backing.
Yeah,
would probably be okay. That's what I suspect they're heading.
I think you're right on that. Because when they said not government backed, I think they meant not Indian government backed. But I think you're right that it may be that they kind of accredit other type things, definitely. Yeah. So we'll see where that one goes. But in terms of what you said about Miami and New York and everything, you're right. I mean, you probably follow some of my LinkedIn posts on what was happening this week with Miami are now proposing that they accept Bitcoin for payments of taxes and that they can use it to pay their staff as well. That's a proposal at the moment. Arizona has been going through a process for 2 years now, where Arizona's looking at using Bitcoin as a means to pay state taxes. So once you can pay your taxes in crypto, that's a game changer, definitely. Hey, Chris joined as well. Good evening, Chris. I guess to say this.
Yeah, good evening. Sorry, I'm a bit late.
No problem. Unusual for you, Chris. You're normally first here.
Yeah, no, we had a mild crisis in the household, but apart from that, no, nothing unusual.
I hope all is well. We're just having a general chat about the future of crypto at the moment and regulatory approval or otherwise in different countries. Because as was saying by Mark, that there's quite a distinct difference in some countries where India keeps flipping between its pro-crypto or anti-crypto. Different states in America are either pro-crypto or anti-crypto. Then you've got Russia. I think the Duomo is about to announce something around crypto.
I thought they had done. I thought it was now. They announced something was legal, that crypto was treated as property or something, I think.
Yeah. They said it could be treated as property, but you could not use it for value transfer or something.
So here they treat it as an asset.
For tax purposes, yeah.
Yeah, for tax purposes. Yeah.
And this is the other thing as well, that you have, even within countries, you've got a bit of a breakdown as to how crypto is treated for tax purposes versus regulatory purposes. And I was doing some stuff. I was helping a regulator in the Middle East a few weeks ago, to understand cryptocurrency. And they were getting very interested as to whether it was considered as money or not, because they are a Islamic faith region, and so Sharia compliance and that kind of thing means the whole thing about whether it's money is quite important to them, and that they were end up being quite insistent that it wasn't money, because that solves a lot of problems for them regularly.
I suppose if they had to, if they treated it as money, then they would have to then first it'd be recognized by the government, right? And then you'd have to have all the KYCs attached to it in that same way.
So that happens already, because if you accept cryptocurrency in some way and you've got like a fiat gateway, so you're converting it to real money.
The KYC is being done somewhere.
Yeah, because ultimately a company that accepts any form of payments, irrespective of whether it's crypto or traditional money, have to do know your customer checks, sanction checks, PEP checks, source of funds checks, source of wealth checks. There are all these things. So that's how I'm working with having conversations with a few firms at the moment around that. And basically they're having to do what you would have to do with traditional money anyway.
Can I ask a question, Gary?
Yeah.
Mark and you are talking about how the 21 million Bitcoin would eventually be mined in 2140. I mean, this is a very novice question. So if there are more computers, more mining coming online, would the timeline not speed up?
No, because written into the protocol are certain constraints. And one is that a new block only gets written to the blockchain every 10 minutes.
So what happens to all the new mining computers that come up and that mines? Would they not be mining more if there are more equipment there?
No, because one of the protocol constraints is that a new block can only be mined every 10 minutes. Okay, now the difficulty of the mining can be increased or decreased depending upon the amount of computing power being thrown at it. So if there are only a few PCs being thrown at it, obviously you don't want complex computing capability. Whereas if you've got a load of super duper mining farms and Antminer S9s and wherever they are, then you have to make the difficulty of the calculation of the hash much, much harder. So the protocol actually manages it. And what it does is it checks over, I've forgotten how many hours now. It basically sees roughly how long the block takes to mine. And if it's beginning to take less than 10 minutes, then it makes the hashing algorithm calculation more difficult to account for it. So if you threw more and more really, really high power compute capability at it, then the hashing algorithm would just get more complicated to compensate for it. So the whole principle is that block can only be mined every 10 minutes.
Is 10 minutes a minimum, or is it an exact always 10 minutes?
It's an approximate. It's give or take, because it takes an average over, I can't remember how many hours it is now. So it means you could have the potential, and this is where there's the concern, if someone got a quantum computer, and say we leapt ahead for a moment, and someone developed a quantum computer which was very, very good at mining, then the sheer order of magnitude means that even though the protocol says you can only mine a block every 10 minutes, then the quantum computer would have solved the puzzle so quickly that it could actually overpower the entire network and rewrite the protocol if it wanted to. Because this is the whole thing, that the idea of 10 minutes and 21 million is written into the protocol, and it can't be changed without the support of the majority of the network, or rather the majority of the network power. So if you suddenly had a supercomputer or a quantum computer or whatever, you could potentially override all the constraints, 10 minutes, 21 million and so on. But you wouldn't.
Why wouldn't you?
Because it would decrease, the whole reason that Bitcoin maintains the value in some way is because of this concept of the limit of 21 million. So you could potentially get enough computing power to force through a hard fork to change that to 42 million. But if you did, you would then devalue the value of any Bitcoin by so much that it just wouldn't be worth doing.
And then you'd have to get consensus across all the nodes.
Not across all the nodes, no.
Oh, no, across half the nodes.
Not even that. You need consensus of 51% of the computing power.
Oh, so if you had a super, super strong computer that was then that 51%, then effectively it would.
Yep.
Yeah, okay.
So this is why part of the thing that happens with the monitoring of Bitcoin in particular is that there are people who actually monitor to make sure that particular mining pools don't actually provide too much hashing power, because ultimately a mining pool could, in concept, become the most powerful network or network contributor in its own right and then control things.
So how are they restricted? If there's a group of people that monitor a mining pool to make sure it's not becoming too influential, too strong, how do they actually then restrict them?
So as I understand it, it's the mining pools who actually do it themselves, because they realize that if any one mining pool became too powerful, that would undermine the credibility of the whole network and therefore would make it not worth mining. So it's almost like a self type thing, that if any mining pool realizes it's getting too powerful for its own good, it actually temporarily racks down its processing capability, is my understanding.
I've got another question, completely irrelevant, different topic, which is in terms of the allocation, portfolio allocation. The general principle with crypto investment is invest that you're prepared with the amount that you're prepared to lose, right? Mm-hmm. And of course, the group here, the members are interested in crypto, and I don't know how much people are in how much you're allocating to the crypto investment. And I was doing a calculation with my kind of portfolio allocation, and I'm just under 3% of my overall net worth. Is that too little or too much? I don't know.
So I'm going to count.
My net worth is not that big. So just to give you, my net worth is not that big. Just to give you.
So I haven't got it written up here.
Is not that bad.
I haven't got it here, but this is not financial advice. I am not a financial advisor. This is an opinion only. Please do your own research, blah, blah, blah.
That goes without saying, yes. I understand.
Yeah. But it comes down to whatever your own position is and what your risk appetite is. So my understanding is if you spoke to a financial advisor, they ask a series of questions to first of all understand where you are in your life. You know, do you have children? Do you have a family? Do you have aspirations? Is your salary likely to increase and so on? And then where you are on the risk appetite journey. So when you are young, you can take loads of risks because if it all goes wrong, you've got time in your life to correct it. Whereas if you're about to retire, you want to go for low risk type things. You don't want to lose your pension basically. So I've certainly seen other people suggest that somewhere around about 5% of your assets, it is an acceptable thing. But it all comes down to the, you know, could you afford to lose 5% of your assets overnight? Would that be a big deal to you? For some people, it's not. You know, if you're a person who has got a high income, but you spend it all on fast cars and fast women and drinking that, then you could spend 20%, you could put 20% in crypto. If you lost it, it means you're having a Porsche instead of a Ferrari type thing. So it really depends on the individual.
It's whatever you feel comfortable with, whatever doesn't keep you up at night worrying and checking prices in the middle of the night, which is very easy to do.
Yeah, with the stock allocation, which is my area, so I talk about sleep number. Okay. So what percentage of portfolio you can allocate safely in a particular stock that lets you sleep soundly. It's a sleep number.
Yeah, and this is the whole thing as well to bear in mind with crypto is because of the volatility of it. You can never really sleep very comfortably if you've got a significant amount exposed there, because you know, we've seen Bitcoin for the last couple of weeks has gone up 25% or something. I've seen it drop massive numbers overnight.
It kind of also, yeah, taking that a little bit further, it kind of depends where you are on your crypto journey. If I think back to, I mean, I got in late 2017, towards the end of the boom that was happening then.
That's what I did as well, John.
And I had so many sleepless nights, or I literally sometimes would wake up in the middle of the night, check the price, panic sell, wake up a few hours later and then think, why on earth did I sell that? Because I just didn't understand what was going on.
Yeah.
I was just overreacted to, you know, a 10% drop in price or something. Whereas now, sort of 3 years later, I see, if as long as I still believe in the actual project itself, then if the price of that coin drops 10% or goes up 20%, it's kind of neither here nor there to me at this moment in time.
Yeah. Well, I got into cryptosphere around the same time, end of 2017, and without knowing much of it. So I kind of followed a couple of people on social media and then bought into various coins and tokens. Didn't sell because the trend is hodl. And then, as you say, the kind of sleepless nights followed. So when it's based and stabilized and went up, it was so hard to then overcome that fear to invest more. So I've been watching the price all along when it went from 8,000 to 19,000 and came all the way to 3,800 or something like that, and now 48 or something. But you kind of still have this scar in your mind of that journey from 19 to 4,000. Now looking back at it, I was wondering, why did I not even buy one whole Bitcoin when it was 4,000? I could have easily bought like 4,000 pounds worth. So because it gone up now, you have that kind of FOMO, or you missed out kind of feeling. So that's why I was wondering.
I guess there is a strategy as well where you take profits on the way up and on the way down, right? So, you know, as soon as you've got kind of how much you put in, it's gone up by that much, you take it out. So then the rest is just profit that you're playing with, or you're willing to ride the wave no matter how big it is.
Your other thing to consider as well is, okay, so you think of crypto as one thing, but there are portfolio concepts within crypto as well. So if you think about, if you've got, say, 3% of your net worth in crypto as a whole, then what do you need to consider about diversifying that in some way to reduce your exposure? And so, you know, this whole split of, do you have some Bitcoin, some Ethereum, some Dash, some whatever type thing, that's worth thinking about as well. However, I would offer a couple of caveats that some people claim that altcoins, so anything other than Bitcoin, are linked to Bitcoin. And so they say, oh yeah, whenever Bitcoin goes up, the alt market follows. That is not true. Other people I know say whenever Bitcoin goes up, the altcoins go down. That is also untrue. There is no absolute correlation between one cryptocurrency's price activity and any other. The other thing to be aware of as well is that you get some people who talk about portfolio diversification, and so they've got some Bitcoin, some Ethereum, and about 10 ICOs or smart contract crypto token type things, without realizing that the ICO cryptos, typically the ERC20 tokens, are all based on the Ethereum network. So if the Ethereum network bombed out in some way, that means you've lost your Ethereum and all the tokens that run on that network. Now that's pretty unlikely, or it is just worthwhile being in mind. If you're thinking of a portfolio split across cryptocurrencies, make sure that you take into consideration which blockchains they're running on as well, because you may suddenly discover that you've got some more exposure than you would perhaps realize.
And I know this group is not for financial advice, but are people able to share how much you are allocating, just to get me an idea in terms of overall kind of diversification with other financial products?
I'll throw in that about 2/3 of the stuff I've got is Bitcoin, but thereabouts. Probably a quarter Ethereum and the rest split into stuff. But I don't invest as a regular major income thing. I do it for the fun. And so, you know, if I lose it all, it's my training. I'm just learning about it. It's no big deal to me. And so it can be quite funny when you look at things like Ripple. So XRP was a small percentage in value of my portfolio until it started rocketing up in price. And it's like, oh, you know, it made quite a significant percentage for a while, and then it plummeted again. So yeah, I tend to say almost if you're looking at making money, either just stick with Bitcoin and learn its behavior and learn how to track it and trace it, because Bitcoin tends to consistently outperform anything else. So I run some of my comparison trades between how much Bitcoin's gone up versus how much the altcoins I've bought have gone up. And generally Bitcoin's outperform them. So it's kind of like, why did I bother? I should have just bought Bitcoin. But if you're doing things like getting into airdrops or free tokens or ICOs, or the equivalent now, STOs, where they can very rapidly see a tenfold growth very, very quickly, then that outpaces any Bitcoin. So it depends how much time you've got to commit to these things.
Because you said you're doing it for fun rather than a bigger investment. So in terms of your investment diversification, this would probably be a smaller percentage, I guess, the crypto investments.
Yeah. Yeah. But bear in mind also, I make a living out of blockchain and crypto education and training. And what I don't want to do is have my a risk that basically my employment income and my investment income are coming effectively from the same place, because that's a risk in its own right. So if the whole crypto market collapsed tomorrow, then that would be pretty bad, and it would wipe out my employment income, but I'd go and do something else. But what it wouldn't do is it wouldn't wipe out all of my investment income, and vice versa.
Sure, yeah, no, that makes sense.
Yeah.
Mark, you were going to say something.
Yeah, so I've got a question about gas fees and things like that.
About what?
Gas fees, and also with Ethereum 2.0. What's granted, we don't know when 2.0 is coming out. It's in the near future. What's the likelihood that gas fees are going to become a lot cheaper if one is trading across the Ethereum network? Kind of what's the effects that will have, and also, does anyone know how to get around expensive gas?
Or to check what the gas fee is at any one moment in time.
So I've been on gas station.
Gas station. Okay, that's interesting.
And it tells you what is going to be a quick transaction if you're a trader or a slow trade. But that can vary quite a bit.
Yeah, I think
that's useful.
With gas fees, it is a matter of doing exactly what you're doing already and just keeping an eye out for things. Answering the other questions in terms of Ethereum 2.0, I was at the London Ethereum meetup in 2019 where Vitalik was presenting, and he said, oh yeah, Ethereum 2.0 is nearly here. So I think he's operating to a different time scale. So you'll always find the one thing he's learned, if nothing else, is to never give dates. It's always it'll be in the near future type thing. So 2.0, when it's going to happen, really don't know. Now, part of 2.0, I think, is the introduction of proof of stake. So moving away from proof of work. Now, that should quite significantly change things like block mining and that kind of thing, which could decrease gas fees. But I don't know if it actually will or not.
Because I've got this quandary where I've made a trade, and effectively I'm moving an amount which is like just double the amount of what a gas fee would be, which effectively is going to be putting me back to the original of what I would have traded in the first place when the gas fees were a lot cheaper.
Yep.
So it's a really hard situation. I'm wondering, what do I do? Do I pay the gas? and just get it out there because it's going to become more expensive. Right? As the Ethereum network grows and as there's more trading, you get more tokens that are really skyrocketing.
I guess the only other option is, can you convert whatever you have into something else like Binance tokens or something?
Oh, I see. Right, and then get it from the Binance chain.
Yep.
Out. Right.
That might be so. I've not tried that, but I know that there are certain tokens or certain coins that operate at lower fees and that kind of thing. And sometimes it might be a matter of converting it to something else and then using that as an intermediary in some way.
That's a really interesting thing to consider. Thank you. So I have done a bit using Uniswap.
Okay.
And those kind of decentralized trading platforms. It is very interesting, different concept of actually getting tokens.
Yep.
A bit nerve-wracking when you do it, but.
And Uniswap is probably something worthwhile suggesting to people. If you've not heard of it or you don't know about it, go and read up about it to see what it does and how it works. There's so much going on in this space. I was speaking to Dean yesterday, and he was talking about the whole DeFi space, and he's beginning to learn about that. I said, yeah, I've been reading about DeFi for over 2 years now. I've read all sorts of papers. I'm a member of various DeFi groups, and I still don't get a lot of it. You know, I still don't understand an awful lot. So yeah, you're right. Uniswap is probably a good one to go and take a look at.
I
And
was going to ask you, Gary, if you're able to give a elevator pitch of DeFi in a minute, but I don't know.
So imagine various financial services, whether it's loans, investing, credit, payments, insurance, or whatever, all operating on the same blockchain, which makes it easier for those services to interact with each other. So you think about how in the UK, for example, you've got the Open Banking Initiative, which was to develop protocols and standards for banks to share data across their different networks. So it's quite clunky. Whereas with DeFi, it's all about having different services, so loans and that kind of thing, all on the one blockchain, so it makes it easy to interoperate. So it means you can do things like you can take out a loan against your crypto on the Ethereum blockchain and earn interest on it, which is paid back through the Ethereum blockchain. So it's all done on a decentralized network, as opposed to you speaking to one firm. That's probably my helicopter perspective of it. So it means you can do things like you can use your crypto as loan collateral if you want to borrow some other crypto. And there's a thing called flash loans, which I would strongly avoid unless you really know what you're doing. And they're quite clever, and they've caused some major problems as well, whereby a flash loan is you can put up some of your crypto as collateral. You can use that to then borrow a whole load more crypto, which you can then use to go and buy some different crypto and play an arbitrage play, and then pay the original loan back, all within one transaction. So as long as that transaction can do something like, you know, go to an exchange, get some crypto at this price, sell it on another crypto at this price, and return the loan back plus interest within a single transaction cycle, then it'll lend it to you like that. And people are using that for millions of dollars, and it's horrific because unless you know what you're doing, you can get badly burned. And there's been a few bugs on that as well.
And all of that is encapsulated within the smart contract.
Yep. So it's it has to instantiate and execute all within that one cycle as well. So if you have something where you effectively get one crypto and you buy another crypto, but then that crypto price drops and you can't pay back the loan, then the entire cycle is cancelled, which is very nice.
As long as you've got your stop loss limits set correctly and...
No, stop losses don't come into it. So
right.
It's just a straightforward, I'll borrow this, I'll use it to pay for this, I'll then exchange this onto another exchange, get the money back, and use that to pay the loan back. So there's no stop losses involved.
Surely there are profits taken out of DeFi. Somebody has to take money out somewhere, and that could be the same cost as a gas fee.
Yep, it can be. You're right, Chris. But it's something that it's definitely worth reading about and learning more about. As I was saying to Dean yesterday, all this stuff goes in cycles. So in 2017, it was the crypto hype with Bitcoin. In 2018, it went into the IPO space and that craze. 2019 was tokens and tokenization. 2020 onwards is DeFi, and it's exploding.
So I was going to ask about like farming and yielding and things like that, and kind of what's the difference in staking, because they all seem like fairly similar things, but I know they are very different, but I don't quite understand that.
I can't go into it in enough detail in this.
Have you got a point of reference that one might be able to look at?
I'll reshare a couple of guides I have which go into various things, yeah.
Because it's like, because you can do yield farming, but then there's some platforms that are really risky where it's like taking your ETH and then giving it to someone, then apparently you get some more back, but you don't really know. And then there's lending on top of that, and which, you know, it's a totally different ball game.
Yeah.
Yeah, that'd be really handy, really helpful. Thank you.
Yeah, I'll share it in the WhatsApp group. I've got, I think it's 2 documents, or certainly one that was done a while ago now, but it's still accurate and up to date. That'd be quite good.
Thank you very much.
Chris, you're being very quiet this evening. Are you just absorbing and listening?
I am indeed. I was just changing the subject. People were talking about cashing out profits on crypto. What would your recommendation be for the best way to get profits out of crypto back into sterling?
Don't do it. Once you're in crypto, you're hooked. Don't take it out.
Absolutely.
But the reality is that most people are putting fiat money in with a hope of gaining a profit and returning it back into fiat again, because at the end of the day, your pension, your mortgage, or whatever is paid in fiat. And different people have different approaches. For some, I think they take it through something like Coinbase and convert it into pounds there. I'm not the right person to answer that because I don't really do it. You know, I just put into crypto and I watch it accumulate, and I rarely convert it back to sterling. But I think some people have used Coinbase. Jag, who's one of the other members who occasionally pops on, he converted his Bitcoin. I think he did it via PayPal recently, because PayPal's now offering the ability to buy and sell crypto, and he did it with PayPal. So I don't know if you can all hear. I've got a couple of dogs in the background, and they can always tell when I'm on a Zoom call, because as soon as I go to speak, they start barking.
In terms of changing to fiat, I mean, that's the purpose of investment, isn't it? To be able to cash it in a means that we can use it in the current usable way.
So I've got a vision that I can buy things in the future with crypto, and therefore I don't need to cash it.
Yeah, you're certainly much more long-term visionary than I am.
But bear in mind that crypto is really funny, because having come from traditional financial services and banking and insurance, where, you know, long term means 20 to 25 years, and I was at an insurance conference 2018, I think it was, and I was saying about how the crypto market, you know, long term they're looking at doing stuff like this. I said, oh, by the way, in the crypto market, long term probably means 6 months. Because things are moving that fast. So we'll see. But you're right. I am thinking of this as multi-year as opposed to multi-month.
A question from me, Gary, and this really is going back to absolute basics, but I don't think I've ever been able to sort of fully answer it myself properly. Why blockchain and DLT instead of any other database? I mean, at the end of the day, blockchain is just a database.
Yep.
So what makes blockchain and distributed ledgers better than conventional databases.
So if you look at the features of a blockchain, any one of them can be repeated using traditional blockchain technology. And in fact, I even had the conversation that this was crazy. I had a disagreement with someone on a panel in, I think it was Mumbai in 2017, 2018, about blockchain and DLT. And this guy worked for IBM, and they were using Hyperledger. And I said, yeah, but you're saying the difference between blockchain and a database. Do you realize that blockchain is a database, at the bottom level? And he said, no, it's a blockchain. So you're using Hyperledger Fabric, aren't you? He said, yeah. So you go down to the bottom level, that uses a thing called level DB, which is a relational database. So at the bottom level, it is a database. The difference is how it's being used cannot be accomplished easily just using traditional database techniques. So I'm an ex-Oracle database administrator. And so, you talk about what are the features of a blockchain. Well, first of all, it's immutable. Well, I can design an immutable database, which is write only or append only. That's really easy to do, actually. Okay, so it's distributed. Well, I've designed distributed database systems before now, so I can do that. It's decentralized. Well, that's a governance thing. That just means there's no central ownership of it. So I can do that. It's programmable through smart contracts. Well, if you've ever looked at a stored procedure in a database, that's programmable as well. So each of these things, and it uses cryptography. Well, I've used cryptography in databases as well, so there's nothing new there. So those 5 features, I think it is, you can achieve each of those with a traditional database. What you can't easily achieve is all 5 of them in one go out of the box. And this is kind of difference that if you get, a Hyperledger, an Ethereum blockchain instance, it's got the immutability, the decentralization, the distribution, the smart contracts. It's got all of that effectively out of the box. Whereas if I had an Oracle database or a Sybase database or a MySQL one or and Microsoft Azure, I'd have to go and build all those things in. So that's the main kind of difference between them, really.
Does it then allow you to scale as well, scale up easily and add more to the network rather than having to reconfigure to scale?
Not necessarily, because again, you can conceptually do that with a traditional database. You can add nodes onto a N-tier Oracle distributed database fairly easily. So I'd kind of argue against that in a way. But it comes down to the whole thing that sometimes the technology, each of the individual features can all be done by existing technology. It is just that consolidation of them just makes it a little easier to do. But ultimately, you could write a distributed, decentralized, immutable, blah, 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 Oracle database or Microsoft Azure database, but it'd be quite hard. And why bother? Because you've now got an Ethereum developer community who are looking after all the developments. You'd have to think about security, you'd have to think about scalability, you'd have to think about all sorts of other things, whereas the community's doing it for you with blockchains.
But then going right back sort of 10 or 12 years, whatever, why did Satoshi Nakamoto then basically not just develop an Oracle database with all those things out of the box as such? Why did he, she, whoever they are, start from scratch as such?
But they didn't. This is the whole thing. If you look at the white paper and how a blockchain works, it is not doing anything new. It is just combining a set of capabilities in a different way. So the whole cryptography aspect, the whole mining aspect, the whole key management aspect, they're all existing things. Nothing new was actually created. It was just the orchestration of those services, in effect, that was different. That's my thinking, anyway. Oh, I might be wrong.
Okay.
So yeah, and this is where, again, you know, I speak to people not just about what difference blockchain makes. Actually, a lot of the time, blockchain's not the right answer for things, because you've got, I think those 5 features I mentioned, you know, immutability, decentralized, distributed, secured via cryptography, and smart contracts, so programmable. Well, actually, it might be that for a platform you're building, you don't need those 5 things. So actually, database is still the right answer. I still say a lot of the projects I look at, 95% time, so, you know, 19 out of 20 times, blockchain is not the right answer. So,
I guess that goes with a lot of IT projects where they use a technology that they've got to hand, and they kind of shoehorn it into a particular use case or need, because that's the solution that they've got at that point in time.
It's either that, or they've worked out if they stick the word cloud in front of it or blockchain in front of it,
get the money.
Yeah, exactly. It's project funding. Yeah.
Or it's whatever system the lead developers have been used to using before, are most familiar with, and are most fond of.
Yeah. Or for one organisation with whichever technology it is they want to start learning about next.
Yeah.
Yeah.
And be paid to do it. Yeah.
Sign of a true techie.
Exactly. We've got about 5 minutes. Has anyone got any other questions or thoughts or anything? Chris, did you manage to rewatch the video about private keys and that kind of thing? Did you learn it?
I didn't actually watch it. I've been a bit hectic this week, but I'm going to go back. It's on the WhatsApp list, is it?
It's on. I've listed it. If you actually go to the YouTube playlist I've created for this group, then just find last week's, and it's up there on YouTube for you to watch at your convenience. And I've repeated that in the WhatsApp group as well, so there's a link to it. Yeah,
that'd be excellent.
It was a very good one. I missed it, but I watched it online. It was very, very useful learning about the different keys, private, public, and the addresses. So thank you.
Yeah, that's good. And I welcome any feedback on it as well, because I'm going to be using that as part of some training I'm doing anyway. And so I sometimes use this group as a bit of a guinea pig for some of the things I do. So it means you get some free insight into stuff I'm doing. But in return, I welcome feedback.
I've heard people say, "Not your keys, not your Bitcoin."
Yep.
Is that true?
Yep.
So even if one's got, say, coins stored on one exchange or another, you effectively have no control over them.
Correct.
So that's why there's a good driver to try and use a ledger, or whatever, to store it.
Exactly, but it comes back to John's point as well, which he made last week when we were talking about this. It comes down to, do you trust the exchange to look after your keys,
or yourself?
Or do you trust yourself? Yeah.
It's the insurance principle. It's how much of the risk do you want to ask somebody else to take on your behalf and pay them for the privilege of doing it?
Sure.
Or are you prepared to take all the risk yourself? Or some
I guess it also depends on how much you invested into it.
Yeah.
It's one of those things as well. As you get more confident, then you get more confident with what you're doing as well. But certainly in the early days, generally looking after things like that are best done by someone who knows what they're doing.
Yeah, no, it's true. Yeah, it's very thought-provoking as well. So
the difficulty comes trying to identify an exchange that, for one thing, enables you to do the trades that you want to do, has the range of coins that you're interested in, maybe, which is where I suppose Binance comes into its own, because it has everything under the sun listed. But then it's the how convenient is it to use? And Binance is not an easy exchange to get your head round, certainly not for a newbie. And then it's, there's been so many horror stories over the last few years of exchanges going bust, or the founders of the exchange running off and taking all the money with them. Is trying to find that exchange that you feel confident is still going to be around and is not going to do the dirty on you.
The other thing to bear in mind as well, I can't remember the actual statistics, so I'm going to use anecdotal statistics, which are completely made up for a minute, but they are 107% accurate. Is that I hear the story that something like 80% of companies know that they've been compromised through a hacking attack. Now, that doesn't mean that 80% of companies have been compromised. It means 100% of companies have been compromised, just only 80% of them realize it. And so the likes of Binance and that, I'm sure they've got really, really good security policies, really, really good controls. They're well respected, but at some point they are likely to be hacked. That's just the nature of it. And so there's that certain inevitability. It's really a question of, do you think one of the world's largest crypto exchanges is more likely to suffer a hacking attack, or your PC? Could be either. And typically it's not your PC that's hacked. But there's one of the guys who's a member of this group who we've not seen for a while, who lost a load of Bitcoin simply because he had an email message from what he thought was his exchange to say, oh, we're doing some updates, please log in and change your password. He made the fatal mistake of clicking on the link provided instead of typing it in. It all looked completely credible, completely legitimate, keyed his details in, changed his password. It all looked fine. And then something made him just think, something not quite right there. And so he logged back in, only to see his Bitcoins leaving his exchange wallet. So these things can happen. Yeah. And I think it was 8 Bitcoin. So that was, a bit of an expensive lesson. So be careful there. Folks, it's just past 6 o'clock and I'm conscious it's Valentine's evening. And so you're all going to head off with your partners now and give them roses and a lovely evening and so on. So thank you very much for coming along. I hope as always it was of interest.
Thank you, Gary.
Thank you very much.
Gary.
Thanks,
See you
everyone.
all again. Bye now.
Bye.
Bye-bye.